Welcome back to the channel. Today, I'm going to share something I've been personally implementing in my own portfolio, and it's a strategy that I believe many long-term investors can benefit from. The question I kept asking myself is, how can I build wealth that not only grows fast but also pays me steady income along the way? And after a lot of research, analysis, and personal trial, the answer became clear: I'm pairing SCHD, one of the best dividend ETFs, with QQQ, one of the strongest growth ETFs. In this video, I'm going to break down exactly why I'm combining them, how they work together, how you could structure your own portfolio using these two ETFs, and the risks you absolutely need to understand before diving in. So grab a cup of coffee, sit back, and let's dive deep into this perfect pairing of growth and dividends. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Let's start with SCHD, the Schwab U.S. Dividend Equity ETF. Why is SCHD so popular among dividend investors? Well, it's designed to track high-quality U.S. companies that have a strong history of paying and growing their dividends. Think of companies like PepsiCo, Coca-Cola, Texas Instruments, and Home Depot. SCHD isn't just about yield, it's about quality. The fund screens for profitability, consistent dividend growth, and financial strength. That's why SCHD has been such a favorite. It doesn't just throw together a basket of high-yield names, it focuses on sustainable dividends. As of now, SCHD's dividend yield is comfortably higher than the S&P 500, and it has a strong track record of dividend growth. If you're the type of investor who wants a reliable cash flow, whether to reinvest or to use as income, SCHD delivers. But, and this is important, SCHD has a weakness. It's underweight in technology. While tech has been the main driver of stock market growth over the past decade, SCHD leans more toward financials, industrials, and consumer staples. This means that while it's stable and income-friendly, it doesn't capture explosive growth in the same way that QQQ does. And that's exactly why pairing matters. Now let's flip over to QQQ, the Invesco QQQ ETF, which tracks the Nasdaq-100. If SCHD is the steady paycheck, QQQ is the rocket ship. This fund is packed with tech and innovation leaders: Apple, Microsoft, Nvidia, Amazon, Meta, Google. These companies are the drivers of innovation, disruption, and, frankly, market dominance. When you look back at the last decade, QQQ has crushed traditional index funds in terms of growth. Its returns have been massive, thanks to the dominance of big tech. But here's the catch: QQQ barely pays a dividend. Its yield is minimal, which means if you're looking for income, QQQ won't help much. And because it's so tech-heavy, QQQ tends to be more volatile. During bear markets, recessions, or tech corrections, QQQ can fall hard. So while QQQ is amazing for compounding and long-term growth, it's not as comfortable to hold if you're relying on steady income. That's where SCHD balances it out. Now, let's get to the exciting part: why pair SCHD with QQQ? Think of it like this: SCHD provides the foundation. It gives you dividends, stability, and lower volatility. Meanwhile, QQQ is the accelerator, driving portfolio growth through high-flying tech stocks. When combined, they offset each other's weaknesses. SCHD helps smooth out the ride when QQQ goes through corrections, and QQQ injects growth into a portfolio that SCHD alone might not deliver. Imagine a portfolio built only with SCHD. You'd have stability and income, but you might miss out on explosive innovation. On the other hand, a portfolio built only with QQQ would give you growth, but very little income and higher volatility. Together, you get balance. You get growth and dividends. It's like having a safety net while still being able to climb higher. So how do you actually structure a portfolio with SCHD and QQQ? It really depends on your personal goals and risk tolerance. If you're conservative and want income first, you might go 70% SCHD and 30% QQQ. That way, your dividends remain strong, while still having exposure to growth. If you want a balance, consider 50% SCHD and 50% QQQ. This gives you equal weight to both growth and dividends. If you're more aggressive and want tech growth but still some cushion, you could try 30% SCHD and 70% QQQ. No matter which mix you choose, dollar cost averaging, investing consistently over time, is key. Don't try to time the market. Just keep buying, reinvest your dividends, and let compounding do its job. And remember, rebalancing annually helps maintain your intended allocation, because QQQ's growth can sometimes outpace SCHD, skewing your portfolio. Of course, no strategy is without risks. For SCHD, the risk is sector concentration. It leans heavily on financials and industrials, which could underperform if those sectors struggle. For QQQ, the risks are obvious: volatility and valuation. Tech stocks are known for their massive growth, but also for sharp pullbacks. If you're holding QQQ, you need the stomach to ride through corrections. Another risk is overconfidence. Just because these ETFs look strong doesn't mean you should put 100% of your money into them. Diversification, adding other ETFs like VU for total market exposure, VSHs for international diversification, or even bonds, is a smart way to round out your portfolio. But if you want a simple, 2 ETF strategy, SCHD plus QQQ already cover a lot. Let's run through a quick real-world example. If you invested $10,000 in SCHD 10 years ago, you'd have built a steady dividend income stream with solid growth. If you invested $10,000 in QQQ, your capital appreciation would be far higher, but your income would be tiny. Now, if you combined them, say $5,000 in each, you'd have captured strong growth from QQQ while still enjoying reliable dividends from SCHD. It's truly the best of both worlds. For many investors, this balance reduces stress. You know you're getting paid dividends no matter what, but you're also not missing out on the next wave of innovation. So let's wrap this up. SCHD is the dividend powerhouse, QQQ is the growth engine, and together they create a portfolio that can both pay you and grow with you. It's not about choosing one or the other, it's about finding balance. At the end of the day, investing is about aligning your money with your goals. For me, pairing SCHD with QQQ makes perfect sense for long-term growth and income. Now I want to hear from you: do you prefer growth, dividends, or both? Drop your thoughts in the comments below. And if you enjoyed this breakdown, don't forget to like this video, subscribe to the channel, and hit the bell icon so you never miss future investing strategies. Thanks for watching, and as always, happy investing.